This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Michael Hiles, founder and CEO at 10XTS. 10XTS helps capital market participants leverage the emerging global decentralized capital market infrastructure. Michael, thank you for joining us.
Hey, thanks, Hall. Appreciate the opportunity to talk to your audience.
Great. And so where are you calling from today?
So we're based out of Cincinnati, Ohio, in the southwestern Ohio area.
Great. Well, let's talk about security token offerings. Can you give us a short overview of the market around those and how they work?
Sure. So security tokens are essentially an application of blockchain technology wherein there's no question the token itself represents an actual underlying security instrument. And so the unit of account and the tracking of the security is done either through book entry or through a form of, electronic certificated token as a share or a unit of an LP. As that unit of account is designated by a blockchain token and then subsequently operates 100% on regulatory market infrastructure and, through licensed intermediaries using a blockchain framework as the actual market infrastructure.
Great. And can you talk about the problem it solves and how it's actually being used today?
Yeah, it's a laundry list of problems that it solves. And when you really peel the onion, it's interesting because you even talk to securities attorneys and even, principal 24 broker dealers that don't necessarily have a deep understanding of the inner workings of market infrastructure from a post-trade settlement process standpoint, how things get settled and cleared. It's just one of those, legacy dark arts inside of the markets. And there's a number of problems that really, if you think about it in terms of modern market infrastructure, really hasn't advanced. Certainly electronic trading came online in the early 80s, which was a Cincinnati invention, I might add. Cincinnati Stock Exchange was the very first to pioneer electronic trading. So we've got a nice fintech legacy history here in the area. But when securities trade and settle, even if they're publicly listed, there's still this monolithic legacy infrastructure of information services providers, clearing agencies. It's just a monstrous undertaking. And it really comes down to the inefficiency of information. And today, if you buy and sell shares of, say, Apple stock through your electronic broker, it still takes a couple of days to actually settle and clear the transaction. And the technology of blockchain and tokens and cryptocurrency, well, we've proven that you can have a near real-time settlement process end-to-end on a global basis using the technology that's immutably provable transaction recordation. And so it really calls into question, well, why are we waiting 2 days to settle and clear a securities transaction in a traditional securities sense? And it can even be longer, in alternatives, for example. And it could take, several days to weeks to clear. You might require somebody to get in their car and drive down to their bank branch and get a medallion signature guarantee to send off to the transfer agent, your bank, to actually get physical signature on paper. And then you have the issue of liquidity itself, particularly in private markets, alternative assets. These are illiquid assets, will typically trade at a significant discount over valuation simply because of the illiquidity issues. And I think that there's an uprising, swelling up in the market that understands that if we can tokenize these traditional assets, can we improve liquidity? Can we run fractional liquidity models, for example? Do I need to dispose of the entire asset? If I tokenize an asset, I don't have to dispose of the entire asset. I can only dispose of, a percentage of that asset necessarily. So there's a lot of emerging benefits, and you can even get into the asset class, of real estate, for example. Can the token facilitate a increase in valuation of the equity because somebody's looking for yield and they're willing to buy up the fractional ownership and buy down the cap rate effectively on the piece of property and the market's in a better position to make those decisions around price discovery. You've got, even emerging opportunities across multiple liquidity and trading pools where a asset could be listed and traded on multiple exchanges and settle simultaneously. I believe within the next 3 to 5 years, you're going to see a complete emergence of arbitrage within alternative markets, just running, cross exchange and liquidity pool, arbitrage and trading models for best execution and smart order routing. So, immense amount of benefits that can come. Most of all, it puts the power back in the hands of the offering issuer and their investors. Because ultimately, our vision, our approach to what we do is it's their asset that's at risk. It's their investors' money that's at risk. And the capital inefficiencies every time someone extracts a fee out of that intermediary layer of the market directly and negatively impacts the performance of the investment and the capital efficiency. And I think we can start to see some compression in, those intermediary and, transfer and settlement fees.
So who's the ideal customer of this security token offering? Who would it be best for?
Right now, we're seeing a lot of corporate issuance, private equity, the real estate market's really starting to lean in, tokenization of real estate, not through necessarily the tokenization of the ownership of the title per se, because at present, exactly 0 county recorders in the United States of America recognize a blockchain token as a form of deed. But placing the asset within a special purpose vehicle and fractionalizing the interest in that SPV has become a very popular regulatory compliant path to fractionalizing ownership in commercial real estate in particular. We're seeing deals as low as, feasibly, to maintain compliance really gets tough when you're sub 5 million on deals. I think over time, you'll start to see the automations kick in and you'll start to see, even early stage companies, reg CFs that are raising $1 million, for example, the sub, $1 million 506s, instruments. Right now, it's still relative cost of capital because of the technology expense in the middle. But, contrast that hiring a traditional broker-dealer is going to charge you 7 and 7 front and back on the money from a traditional broker-dealer standpoint. Certainly, corporate issuer, any issuer that's looking to organize and raise capital for a project, if you can get cost of capital sub 500 basis points, that's probably a pretty good deal.
Great. And so what do you need to set up a fundraise here? What does it take to put one in action?
We start with the law. There's a lot of folks that are still very enamored with the technology piece of it. And certainly the technology is a differentiating factor. No amount of cool technology is it's never going to compensate for a bad deal. And you've seen, I think, a fair amount of that just in the blockchain market. There's been a lot of, razzle dazzle, glitter. And, the sachet of the new tech is at this stage, I think, in the evolution of the market, it's just simply not there. I think you're seeing a lot more sophisticated institutional folks leaning in. They're not afraid of tokenization and tokenized assets by any stretch, but it first and foremost is a security offering. So you start with a process. We've kind of defined, we call it the ATLP, the Asset Tokenization Lifecycle Process. And that really stems from our background in traditional records management, governance, risk compliance, from the life cycle of records and how an asset is created and goes through a primary offering, goes into the secondary market trading and listing. But there's structured steps each step of the way. And of course, it starts with a primary offering. You need to structure your offering with your law firm and, engage all of your service providers because it's a security. And so anyone, whether it's a startup that's trying to raise, regulation crowdfunding or a 506 private placement, or even a sophisticated family office that's looking to convert on, some existing assets through some form of, 506 or private equity offering, limited partnership. It really starts with a savvy law firm that is certainly knowledgeable and up to speed on the technology. And then it moves into the normal process of a primary offering, depending on your registration or your exemptions, what you can do. Can you openly solicit for that offering? We try to automate that upfront process from an investor experience standpoint. So all of the KYC, AML, identity verification, accredited investor checks, the subdoc subscription agreements, all of that workflow, payment facilitation for the actual allocation, try to bundle that up into a seamless process for that upfront investor. We grab all of that data and then tokenize that as a metadata layer. And then at that point, you're in position to generate what we call a layer one token, which is a public blockchain token that converts from a book entry, from whether it's an issuer managed cap table or a transfer agent managed cap table. We convert that book entry into a certificated form of transferable unit of account. And then it moves into the secondary market ecosystem, listing on, the ATSs and exchanges, and then moves, in a regulatory compliant fashion through the custody system. The SEC has absolutely articulated a 3-step process for regulatory compliance of secondary market trading of these tokenized instruments. So, but it starts with your law firm, starts with a traditional PPM, and all of the book that would entail a securities offering.
So, what's the most common mistake people make with security token offerings?
It's an interesting question. Aside from just thinking that the technology is going to fix their crappy deal, being overly focused and enamored by the technology in general, the fact that it's a token is really irrelevant. It's just a unit of account. It's a fancy, blockchain's a fancy distributed spreadsheet. It's a ledger. And I think that, there's been a push, early entrance into the space, some great pioneering projects that got a lot of press, but then there were a whole bunch of projects very early on, generated layer one public blockchain tokens, called them, shares of a company or, units of a limited partnership. But then it got caught in that market infrastructure slog. And prematurely focusing on a layer one token is probably the biggest mistake. Tokenization, creating a smart contract that generates a blockchain token, that comes several steps down the road, right? You still got to bake your actual offering. You've got to go through the normal primary offering process that has nothing to do with blockchain, right? It's subscription agreements. It's traditional subscription, payment facilitation. And all of that metadata has to be associated in some way with that token so that that token is now provable as the security that it's being claimed as it's supposed to represent. And I think premature focus on that token just because of the enamorment with the technology and the glitter and the razzle dazzle, I like to call it, of the fact that it is blockchain. Yeah, it's cool. I'm all in, right? I burn the bridges behind me as CEO of our company. At the same time, it's really boring because it's market infrastructure. It's how, licensed intermediaries communicate information back and forth with each other. And aside from having your MetaMask wallet, you open it up and look at it, and cool, there's some, tokens in there. It's really not that meaningful.
Right. Well, what should someone expect who's putting a security token offer together? How long is it going to take, and what's it going to require, and what maybe the gotchas there?
Well, I spend an awful lot of time with attorneys and law firms, and I love them dearly because they are many are leaning into the space and learning blockchain, just in all forms. It's exciting, it's exciting times. But I have the saying, it's kind of derogatory, but not. I think everybody will know exactly what I'm talking about. It's business at the speed of law firm. So the faster your counsel can get your offering structured and out the door, then the meat and potatoes can start. From a technology standpoint, you're not necessarily talking about a lengthy process unless you're trying to do something at the institutional level with a lot of custom enterprise integrations with existing line of business systems, accounting systems. Like if you're trying to tokenize a REIT, for example, and you've got to contemplate, thousands of K1s for token holders, and you don't want to have to reinvent the wheel on generating these things. You want to be able to dump those out of your Dynamics or, whoever you're using as accounting system. You've got to contemplate those types of integrations. And so you're usually anywhere from 60 to 180 days in terms of organization from a primary. And then as it moves into the secondary, of course, secondary markets are, pursuant to your registration and your exemption, in particular, your 144A restrictions on the transfer of a secondary market security can, certainly radically affect the time frame of listing the token on exchanges. Could be as much as a year, right, to season a 144A under the law, which has nothing to do with the technology. So you have plenty of time to contemplate, listing agreements with ATSs and getting your custody situation with the banks all arranged. Even if you file a Form 10 and reduce that 144 from, a year to 6 months, that's from the close of the primary offering. So, however long it takes you to market, and I guess proportionate to size of raise any other securities offering that you're putting on the table.
Great. So just to switch gears here a little bit, what online information source do you might find most helpful in this area?
I read a lot. I mean, there's a lot of great resources that are out there. I lurk on Twitter pretty heavily. I think that Twitter really does have the near real-time finger on the pulse for breaking information and news. Twitter and Reddit are probably the two, just, tracking blockchain, cryptocurrency, finance trends, because it's really an amalgamation. It's not just one competency. You're talking about a whole bunch of really complicated and nerdy and boring vocabularies all combined into one. You've got finance, you've got law, you've got regulatory and legal, you've got, of course, the technology side of it. And, that crosses over into traditional crypto and monetary policy and economics. It's really, you kind of got to cover a lot of ground. CoinDesk, obviously, the block, in the crypto space. You've got some really great publications that are focused specifically on the cryptocurrency and the blockchain side of it. There's not a lot in the securities token space per se, because it is still such an emerging, very small tip of spear, next evolution of the markets. I anticipate that, you'll see a lot of growth, particularly as more and more projects come online, billions more in assets start pouring in. You'll start to see, even traditional outlets start to maintain analysis and coverage of the tokenized asset classes.
Great. Well, there's a lot going on in this space. If you could start a business tomorrow, what would that business be in this area?
I really thought about this because it's tough. We bit off a big bite when we said we're going to tackle the regulatory compliance side of the discussion. Oof. Right. And that all by itself means that, for the folks that said, no, I'm going to ask for forgiveness as opposed to asking for permission, many of them are out there. Well, many of them have seen the inside of a courtroom, but then there are many others that have also paid their fines and danced on down the road with their billions in their bags. So if I were to start over again, maybe find a little bit of a balance between the regulatory and the non-regulated use cases of the space, maybe not even outside of finance. I'm looking at like supply chain, and there's great projects in, a lot of those spaces, healthcare. Information is information. Trust technology like blockchain, the ability to create a consortia of data that's used by multiple, common enterprises that need to share that common data. It's a fantastic use case. It's a marvelous use case. To me, it's one of the only use cases. Why have a distributed ledger of common single source of truth data? And there's so many applications of that across so many use cases. And I was, talking to a colleague of mine about even IoT sensing devices on mesh networks from a FCC and a ULC certification, just on the operation and the logging of the proper operation of electronic devices on a network, right? And just simply aggregating at scale, millions and millions of messages a second, across a wide area or a mesh network. I think there's so many use cases of the same technology that we took the hard road because it does require the law and the regulators. But I think that in the end, the path that we've chosen been great. It's been a long time coming. I think 2022 is definitely the year of securities tokens and tokenized assets without question. I think the market is finally awakened when I see very large buy-side alternatives, institutions that are looking actively for offerings to acquire in this space. I think that you're going to see a radical expansion in that space, which is good because it's been quite the journey.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I know your audience is largely focused on investing and, early stage and in angel investing from a activity focus standpoint. This is a phenomenal shift that you're seeing right now because of the advent of the technology. It's really radically impacting venture that I'm seeing the writing on the wall. Traditional venture, while it's, still running at all-time highs, you're starting to see some very interesting projects that are forming distributed autonomous organizations, DAOs. People are buying into the DAO and getting governance tokens and then making democratic decisions on allocation of the funds to acquire assets and invest in projects. I don't know if you saw, some time back that there was a DAO that was formed to try to buy one of the only copies of the Constitution. right? And they called it Constitution DAO. And I see the democratization of investing really shifting. And I think it's going to put a lot of pressure on investors that focus on early stage to really refine their thinking and what their hypothesis is in investing in these types of projects and how early stage technologies are funded and what does a capital formation project look like in the early stage angel space and the early stage investing space. And I think that there's just as much opportunity as there is risk for smart, forward-thinking investors, that are looking at even forming funds. I'm starting to see early-stage fund projects that are now organizing around these types of hypotheses. And I think that it's really a bellwether moment in the venture capital space in particular, that it's going to be that digital transformation thing's great when you're talking about investing in a portfolio company, but is it as great when it's threatening your own core business model as an institution? It's like, well, the inevitability is here. So that's one area that I would encourage your listeners to really lean in and pay attention to. There's some really cool projects. There's been some really novel. There's a lot of bright people in the space, and the rethinking of capital formation is really underway right now. And even at the regulatory level, the SEC, you're starting to see the SEC rattling the saber about, wanting to rethink the 2000 investor rule, special purpose vehicles, and peeling the onion on the number of shareholders under 12G. And a lot of those things are really going to become more and more mainstream discussion over the next, months, years. And another area I'd like to see revisited, back under the Obama administration, the SEC had taken up a conversation around venture exchanges. And there was a lot of discussion around liquidity and early liquidity for LPs that are in venture funds that have 10-year horizons. How can we rethink the secondary market when it comes to venture exchange projects? And I think that you're seeing finally the technology and the acceptance of the broad market to embrace alternatives. And at what level does the National Venture Capital Association, the Angel Capital Association, and all players in the space, do they need to revisit the SEC conversation about secondary markets for in particular equity VC funds from an exchange standpoint? I think that that's an interesting opportunity that can reemerge.
Right. Well, I agree. I think security token offers, their time has come, and we're going to see a great uptake here this year as well. So looking forward to seeing the roll out in the market in a bigger way. So how best for listeners to get back in touch with you?
I'm pretty easy to find at Michael Hiles on Twitter, on LinkedIn. You can always reach us through our site, 10xts.com. I'm pretty easy to get a hold of. The team is growing and building, and I'm sadly losing touch with my my audience. For direct, they got to keep the CEO off in the corner and don't talk to anybody. but I'm always happy to engage folks and learn about your project and figure out how we can really help facilitate, whether it's at the fund level. We spend a lot of time in institutional discussions right now, less so on the startup offering side, but, lots of really cool conversations are going with, the PE groups and the equity funds, VCs. There seems to be a fair amount of interest in reshifting, forming a new fund is always a lengthy process in and of itself, and, fund formation. But if you're contemplating a tokenization strategy, you need to start thinking about that as you're planning the offering, right? You can't wait. And then I always say, blockchain's not like a Christmas ornament that you hang on the tree after the fact. It's like kind of it's the trunk of the tree. You got to contemplate it at the base, and you just don't hang blockchain on like an ornament. It's got to be architected in from the get-go, and that requires buy-in from the law firm, the auditors, and everybody across the board. And it has been around long enough now. There are successful models to point to, and from a risk mitigation standpoint, I think that folks are looking for those kinds of strategies. We do a lot of advisory, and we're here to answer questions and help.
Great. Well, we'll include your contact details in the show notes. I want to thank you for joining us today, and hope to have you back for a follow-up soon.
Always happy to chat, Hall. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.